Hi, welcome to this episode of Living and Working Abroad. I think I've gone live and I get a thumbs up from my team for that. Um, but there was a bit disorganized there, so we're kind of organized now. So if you can hear me, just acknowledge that. Thank you very much. Welcome to this episode of the Living Working Abroad show. What we're looking at today is looking forward to 2025 and trying to anticipate some of the lessons that we've learned from 2024, which was a bit horrendous in a number of different ways. And I'll give you my short summary of that at the end of this event. So I've got five things to significantly discuss that impact expats and people living and working abroad in 2025 from a UK perspective, affecting EU citizens, but affecting people around the world. First of all, today's January the 8th, and today is the day that the Electronic Travel Authority is introduced into the UK. Not the EU, because the EU have yet again deferred implementation of electronic travel authorities while they get themselves organised, which is the EU way that we've seen over the years. So let's consider now that we've got a UK-wide global application of electronic travel authorities in the UK, who that applies to and who needs electronic travel authority to travel to the UK. Traveling to places like USA for many years now, you've had to have an electronic travel authority in addition to your visa-free travel. Visa-free travel is something that has been agreed and enjoyed over the last 100 or 200 years around for countries around the world. Visas are sometimes required to check out who's entering a country and who's not. And gradually, over the last 20 years, we've seen this creep of technology. An electronic travel authority allows visa-free travel to actually then be regulated and monitored online. And this is what the electronic travel authority is about. It's about verifying who you are and your right to travel into another country. So from 8th of January, all UK all UK travel into the UK from outside the UK potentially needs electronic travel authority before the travel. So when you're checking in on the airline, that is when they will be checking your electronic travel authority or making that a requirement. So visa-free travel with a passport is not enough now to the UK. You also have to have an electronic travel authority. Now, there's an exception to that. For those of you that listen to the Living Working Abroad show regularly and follow us on YouTube and our website at priorpartnership.com, those of you who follow us regularly will know that there's not just a double taxation treaty between the UK and different countries around the world, but there's also a social insurance agreement with different countries around the world. And one of those is the EU. Now, the special relationship between the UK and the EU is something in flux at the moment, but at the moment, Brexit has happened. The UK is outside the EU, but there is a social insurance agreement which involves an exchange of information between social insurance authorities. But what that basis, what that arrangement has also meant is that if you're from the EU, um, you do not need the Electronic Travel Authority to travel into the UK. So even though the UK is no longer part of the EU, um, under the post-Brexit and current arrangements, an EU citizen with visa-free travel into the UK can continue to do that without electronic travel authority. And there's no time limit on that at the moment. That is the rule that's introduced is for people around the world. So electronic travel authority had previously applied in 2024 for people from the Gulf states, from the GCC, but from 8th of January today, non-EU citizens around the world have to apply for an electronic travel authority before they enter the UK, except and accept the bureaucracy of the EU. The Schengen zone in the EU doesn't include all EU countries. There's two countries that are not in the Schengen zone at the moment. From the start of 2025, big changes that now Romania and Bulgaria are full members of the Schengen zone, and for certainly for their land borders. So anybody in the EU can drive into Romania or Bulgaria without passports. The border for the EU is the border, the external borders of the countries like Romania and Bulgaria. Bulgaria has got an external border to Turkey, for example. So Romania and Bulgaria are now fully fledged members of the EU. Croatia was the last country to join. Um, the island is not committed or not applied to join the Schengen zone at all. The history of that is to do with the common travel and trade area between the UK and Ireland, which dates back to the 40s. And that supersedes post-Brexit any EU relationship. So um, travelling into the island as an EU citizen, non-EU citizen, EU rules apply. But between Ireland and the UK, it's UK common travel arrangements between Ireland and the UK that apply. So once you're in Ireland, if you're British, you can freely travel to the UK. Obviously, that's not going to be the same if you're non-EU or non-citizen, non-EU citizen, but that's a different journey that you need to take. But there's no Schengen zone rules going to apply for the foreseeable future in Ireland. Unlike Cyprus, which is now the one EU country that wants to join the Schengen zone, but it's not in the Schengen zone. The Electronic Travel Authority for the EU has been delayed. Part of the reason for the delay in that will be connected with integrating Cyprus into the Schengen zone, which has now been deferred and is not, it's anticipated to be enforced in 2026, but that has not been ratified or progressed significantly in the 2025 December EU summit meeting of leaders. So we roll into another year with Cyprus being an applicant member for the Schengen zone and not a full member of the Schengen zone. The implication of that for Cyprus citizens who want to travel to the UK is that if you are a Cyprus citizen and if you have not got dual residency with the UK or an existing permanent residency, then you will need an electronic travel authority into the into travel into the UK. So the electronic travel authority does not apply to EU citizens, but it does apply to Cyprus citizens because Cyprus is not in the Schengen zone. So if an EU citizen has got a residency or permanent residency in Cyprus, but they've still got their residency for Spain or Portugal or France, they can travel from Cyprus into the UK on their home country residency permit or passport without an ETA, with their EU status, their EU ID, their EU passport, travel into the UK, even from Cyprus. A British person can travel from Cyprus into the UK as a British citizen. But if you're a Cypriot citizen, as well as an EU resident and an applicant member of Schengen zone, you currently still need electronic travel authority to enter into the UK under the current rules. Essentially, what they're saying there is that the UK trust the Schengen zone checks on people from non-EU countries, and with Cyprus issue with Schengen being where it is, they can't trust that. So to secure the border, the Cypriot citizens still have to have the electronic travel authority until the Schengen zone situation is resolved. Okay. Now, the application for Cyprus membership of the Schengen zone was considered in December 24 at the summit meeting of leaders, and basically Cyprus have been given a clear issue to resolve in 2025. In Cyprus, there's a clear border between the Turkish north and the Greek Cypriot south. And this is a result of a sort of a conflict back in the 70s, which has still not been resolved. Uh, the EU tried to resolve that when Cyprus joined the EU in 2024 and made the resolution of that 1974 division of the island a part of joining it, but that fell through political complications. So now with the application to the Schengen zone, that ultimatum has then been given to Cyprus that they've got two options that they need to decide in 2025 to create a hard border between the north and the south of the Cyprus island, or to reconcile and so it's one government with two federated states or whatever the final solution is on that. So that is the decision that we're going to see in 2025, whether we get this radical change in the Cyprus nature to settle a long-running United Nations managed border, a land border, a disputed land border, the only one in Europe, and get that resolved so that Cyprus can join the Schengen zone and electronic travel authorities are not required to the UK for Cyprus citizens going forward. That's a summary of Electronic Travel Authority in 2025, the change of regulations for entering the UK, the EU, and Cyprus. For more information and guidance, you can contact us at proactpartnership.com and or contact us and message us using online chat and other methods. Now, the next big thing I want to discuss, late in 2024, in the Halloween budget, the UK came up with a change to the non-dom rules. Now, this had already been signposted, already brought in the previous April 24 budget that the non-dom rules would change. It was something that was intended by the incoming Labour government, and they've reinforced the proposed changes already. So the non-dom rules are going to change for expats from the UK and into the UK for sure from December, so from April 25. So there's big changes coming up. The two things that will do is that if you're an expat in the UK at the moment, you have to be there at least 15 years to be deemed domicile in the UK. So non-doms in the UK can earn take dividends and interest from around the world without paying tax on those earnings, dividends and interest. That they only pay tax on the remitted income. So Rishi Sunak and his wife were living in England as the Prime Minister, but because his wife was non-dom, because of the family, her family's businesses in India, her multi-million pound dividend income wasn't being declared in the UK because she was claiming that she was a non-dom and it was not remitted. Now she since reversed that position, but that is the type of person that's going to be affected. So if you're not British, an expat living in the UK, uh, from the tax year beginning April 25, you'll be liable to tax on your worldwide income and gains wherever they arise. There is one caveat to that, and that's the 4-year rule. So generally in the UK, if you've been in the UK for 5 years, which is the minimum in international law, to start getting any sort of permanent residency or citizenship, you can apply for permanent residency in the UK or indefinite leave to remain, as they call it. Um, um, but you can also, once you've got that indefinite leave to remain in the UK, apply for citizenship as well. And many countries around the world allow for dual citizenship. Some countries don't, but that gives you the option to do that. So the non-dom status is being retained in the UK for people on short stays up to 4 years. So if you want to stay in the UK for more than 4 years, then you become considered domicile and therefore liable for tax and income on your worldwide income. If you're there for a short working trip for 1, 2, 3, or 4 years, then you actually can remain non-domicile and still enjoy the similar tax benefits to today. If you've been in the UK for 4 years, for UK tax years at April 25, then you automatically fall under the new regime. So this is not something that starts counting from April 25. The count is already on. So by April 25, if you've been in the UK for 4 years, then you're liable to tax on your dividend, interest, and earnings worldwide, remitted or not. If you're an expat in the UK, whether you're a citizen, indefinite leave to remain, or just on a working visa. Uh, this might mean you need to review your circumstances and your situation on your residency in the UK with your non-dom status, and you can do that by contacting us at preemptive.com. Now, how it's going to look going forward is that they're going to be basing your domicile on a residency basis. So there's a statutory residency test at the moment, which uses days in the country, family ties, accommodation, working days in the UK, as well as your habits and your intentions and your rules. So if you're visiting the UK twice a month, or during a working week or a short working week, you can create a habit that will be deemed due to be tax resident, even though you don't qualify on the number of days. But essentially, the tax residency, if you're deemed to be tax resident for the year, you're deemed to be domiciled for the year. So if you're in the UK for 4 years, but you're not tax resident in any of those 4 years, then it doesn't count towards your 4 years of domicile. Important point. So you can still work in the UK a short period of time, as long as an expat going into the UK to work, you can do that, but you remain non-tax resident for those short periods of time. And it's all comes and centres around making the tax residency test more relevant to all expats, whether they pay tax on dividends, interest, or earnings abroad. The next issue to consider on the non-dom status and how that changes is that if you're in the UK for 2 years and then you come back 2 years later for another 2 years, does that count? Well, yes, it does, because the 4-year measure isn't just taken as a snapshot. Potentially, you're going to extend it beyond 20 years, but in a short and simple basis, you consider over the last 10 years. So if you've done 4 UK tax years over the last 10 years, then that would be enough from April 25 to deem you domicile in the UK. So your ties, your home, whether you've got owning a property in the UK isn't a home. It's accommodation that you keep, whether that's with family, with friends, with a rented apartment. If you keep your accommodation, then that is a home, and you stay in that accommodation, that is a home. But not for just owning and renting property. That's still available to expats living and working abroad. And the capital gains tax rule moment where you can accrue capital gains tax in the UK but have the liability deferred if you're not tax resident, that rule still applies. So if you're an expat that's working in the UK, worried about the non-dom status, want to change, if you leave the UK and then start making your plans to become non-resident and capitalise on UK gains, then potentially you can defer that capital gains for up to 5 years. Different rules, different complications for residential property, commercial property and investments that need scrutiny and investigation. Product Partnership offer advice and reports on that. And you can contact us for a consultant's call or report at productpartnership.com. Another reason that expats might reconsider uh, whether they remain in the UK or they choose to live and work abroad is a corporation tax rate. So if you're a consultant that's working remotely in the UK through a UK company, you might be happy to enjoy the corporation tax rate of 19%, as was. However, that's now gone up. Again, uh, the Tory government, the failed Tory government, did what was planned by the Labour government by putting up the corporation tax rate to 25%. So that's the higher scale within the group of major leading industrial companies, countries around the world, rather than being in the middle. The minimum rate being proposed by the G7 countries is 15%. There were calls for it to be reduced to that, but that was abandoned and in fact increased it to 25%. So that now sticks. So if you're working as a contractor or you're working your corporation as a small business, um, then your corporation tax rate is 25%. Plus your payroll taxes have gone up with national insurance rises, and not a wealth tax, but another 1+% on top of national insurance, which is similar to the last government did over the last 5 years. So we've got this incessant increase in the cost of corporation tax and running the business and the employee, the payroll for that. So how can you remove and change that? If you've got a holding company, the holding company can uh, be a new base for you, and that holding company can be based outside uh, the UK. So um, this is done by many countries around the world, and when you go to low tax havens, there's significant costs involved in terms of a registered office and administration and control being established and demonstrated from the offshore location. However, if your circumstances allow and you can manage and prepare to take the actions necessary, then it can be possible to work remotely in another country with a holding company and reduce your corporation tax level from uh, 25% down to 12.5%. So a country like Cyprus, stable EU member, not in the Schengen zone or NATO yet, but pretty close, you get a 12.5% corporation tax rate for your trouble. Now, there are additional expenses and different ways of doing that. So the cost of administering and managing that remote business will mean to start making the tax savings, you need to be earning a significant income using a corporation. And we're talking about there in the region of 60 to 70,000 a year turnover to make the corporation tax savings become significant and relevant. Have in mind that if you're working with your own UK company with potentially a corporation tax rate of 25%, you can accumulate all your wealth within that and just pay 25% flat corporation tax. But then you've got personal tax or dividend tax up to 39% that can be charged when you take that money out of the company. So another option that you've got is go to work remotely as a contractor of your own UK company, and that would allow you as an individual to be able to draw income and capital from that company, potentially at a lower rate. So a contractor based in Cyprus will pay 0% on dividends and interest, um, uh, and uh, and potentially, depending on how they worked it, and if you were paying into the social insurance scheme, you could also pay tax only on a remitted basis, the same as the UK at the moment. So remittance basis for contractors is available in Cyprus and remains so, and is not likely to change anytime soon. For more information and guidance, working as a remote contractor or for creating a holding company for your UK corporation tax to enable you to reduce your corporation tax and your business taxes in half, contact us at preemptive.com. Another significant change, it came about in 2024, but based upon a law change at the end of 23, but it's just beginning to be rolled out and enforced going forward. The law actually came into force on the 1st of April, but it still takes some tweaking in Cyprus before it comes full into flood. But it's something to consider. In the UK, an expat can go to the UK, and after 4 years, they're deemed to be domiciled and not domiciled anymore, and the non-dom status is lost. And after 5 years, they can apply for permanent residency, indefinite leave to remain, or citizenship. Now, in a country like Cyprus or Spain, was similar, you need to be in the country a lot longer before you can apply for a citizenship. So it's 5 years for permanent residency, but longer for citizenship. Now, a country like Cyprus and many other countries offer what they call golden visas. This is a fast-track route to permanent residency, the indefinite leave to remain, by making an investment in property or in a company. You can get that permanent residency straight away. It doesn't accelerate your qualification for citizenship, but it can accelerate your qualification as a permanent residency, which means that it's easier to justify your tax residency in a country as a permanent resident than as a 1-year annual residency visa. So consider that. Consider permanent residency by investment, the golden visa route. It means you're either creating a company or buying a property, and potentially having a cash sum which might be required to be put on deposit or into property of around about 300,000. But if you're able to do that and you want to do that to create a permanent residency on day one, a private partnership can help you if you contact us at preemptive.com. Big change for Cyprus in 2025 is that citizenship is now available with much less residency. And it's actually gone from a minimum 7 years tax residence to now it's much more flexible, and you can get citizenship after a minimum of 3 years. So you've got the fast track route to get the permanent residency, which is not the citizenship, but if you wanted the citizenship as well, you can now do that a lot quicker. You actually, there's a standard route to citizenship in Cyprus now under the new rules, which means that you have to be in the country for 7 out of 10 years as a tax resident and in the last 12 months, with a language qualification and a non-criminal record. So anybody under the old route, if you're a resident for 7 out of 10 years, you've got the route to be able to become a citizen, which you may not need if you're an EU citizen, but if you're a non-EU citizen from the Americas or from Asia or Africa, then it could be a way forward to create an EU citizenship going forward and in the future. But now, for Cyprus residency, there's a fast track route whereby you could get citizenship after a minimum of only 3 years. So for 3 or 4 years residency in the last 10, as long as you've been in the country for the last 12 months, you can now get citizenship. There is a requirement to know about the Cyprus culture and to speak the language, but we can do that now once you've got a minimum of 3 years. So some countries require language skills when you join, other countries don't. And Cyprus does require the ability to speak Greek, even though the official languages of the country are Turkey and Greece. But if you can get through that, then citizenship is available at a very short term, if that suits you, given that you're coming from an African American or Asian nationality and want to get and acquire an EU citizenship. For more information about how to fast track into EU Cyprus citizenship, after only 3 years, contact us at proactpartnership.com. In this week's Living and Working Abroad show, we're looking forward to 2025 and some of the significant changes that are going to come about and affect people that are living and working abroad. As you know, I love talking about tax and residency, and this is our focus. And for over 20 years, we've helped expats that are living and working abroad to be able to do that, using our EU Cyprus office as a base for UK expats living and working abroad, as well as EU expats. We've seen many changes over the years, currents and flows, but what we do know is that Cyprus is consistent in what it does, and that any changes it makes are slow and steady and not rapid and varied. So despite the EU pressures, Cyprus maintains its low corporation tax rate of 12.5%, maintains 0% tax on dividends and interest for individual expats, whether they're working from a Cyprus company or their own company. But also they have a very good uh, uh, capital gains tax regime where there's zero capital gains on anything effectively but apart from Cyprus real estate. So if you buy a property in Cyprus, you've got potentially a flat rate 20% capital gains tax on that. But apart from that, there's no capital gains tax and no inheritance tax. Now, this can be quite attractive when you're in a country with high inheritance tax liabilities, like the UK. So the UK has got one of the highest inheritance tax rates of 40%. So if you're unlucky to die in the UK, then as a UK domiciled citizen, you've got this potential liability to 40% inheritance tax on your worldwide assets. Now, for many years, UK expats living and working abroad, even though they're still domiciled to the UK, the UK didn't necessarily find out about their state. There's ways to manage it. So if you don't need to do the heritage tax declaration in the UK for an administration in the UK, the UK didn't necessarily know that you died abroad and therefore weren't able to apply the inheritance tax uh, assessment that might otherwise apply. Now, with the change in the non-dom rules, that is one thing, and that moves it beyond that. So a UK expat now can um, leave the UK and after 20 years be deemed to be non-domicile just by being out of the UK for 20 years. And that wasn't necessarily possible before, depending upon what your circumstances are. We wait to see the final version of the law in April 25. But it's just worth considering all the same exactly what is happening in terms of inheritance tax, because there's slightly seriously more to consider. So once you're deemed domicile in the UK, um, you're also liable to inheritance tax on your worldwide assets of 40%. So if you become that British citizen, you become that resident for more than 4 years and you're deemed domicile in the UK, you're liable to inheritance tax on your worldwide assets. Put that alongside the fact that if you then leave the UK, you're still deemed domicile for up to 20 years in the UK. You have to leave the UK for up to 10, 15, 20 years to shape that tie that you've acquired of domicile to the UK and that inheritance tax liability. Except, how can the governments manage that? How can they uh, assess that if there isn't necessarily any information available to them? So the world 40 years ago was very paper based and it's not anymore. Technology has crept in, computers have come along, the internet has come along, and governments have learned to use the internet, and the governments now require everybody to register with their own unique registration. So they've got an electronic identity of the individuals that they're dealing with. The borders, the flights are controlled with electronic travel authorities. as well as the airlines exchanging information. So you're registering on the airline with your passport and now your electronic travel authority. So they know which border you're crossing, when you're crossing it, and how you're crossing it. Not necessarily within the EU, but that's the nature of the EU to become one unified state. Within a country, crossing that border with a passport electronic travel authority increases the amount of information and data exchange that they can do. Uh, the French-based OECD in Paris introduces a range of uh, diktats and changes for tax law internationally. And there's another pillar of regulation coming out in January 25, which again will significantly change the way of the world going forward. So let's have a look at and consider some of the changes in the OECD tax regulations and what they mean in 2025 for expats living and working abroad. Well, the changes for this year are actually involving exchange of information for more than just individuals and companies. It's also involving trusts. So trusts are now wrapped up in this as well. Again, Cyprus EU office is based in Proact EU office is based in Cyprus. So we centre a lot of our advice and recommendations on Cyprus because it's very tax efficient, stable, UK English speaking type of economy. As well as being part of the European Union and potentially a member of the Schengen zone eventually. What they also run, having this association with English law, is trusts. So unlike countries like Spain and France, Cyprus will recognise international trusts. So somebody who is not a resident in Cyprus and not a citizen in Cyprus can open an international trust for their family and business, and that family or business will not pay any Cyprus tax at all. That Cyprus International Trust for family or business pays no tax at all. Not just dividend tax, 0%, or interest, and not on investments, not on earned income, not on capital gains of the shares that the trust could hold, but also no inheritance tax. And this is the key. Inheritance tax is only paid generally when you die. And with a trust, traditionally, they weren't quite as heavily regulated as other countries. But anti-money laundering and anti-terrorism rules are being used to tighten up the way that trusts are regulated. So from the start of 2025, a trust in any country, but in Cyprus, including Cyprus, has to be tax registered with its own tax number. It has to be tax registered, regulated by the local anti-money laundering and terrorist financing organisation, and there has to be a declaration of the ultimate beneficial owners. So if you own an investment, or if you own a bank account, or if you own a company, over the last few years, the investment and finance manager companies have come to you to identify who the beneficial owner of that asset, of those shares, of the investment, of the property, who is the beneficial owner of that. If the property is sold, if the business is sold, the dividend is paid, who receives that income? Now, in the past, that could have been another corporation, a holding company. So you have to declare with that holding company who the beneficial owner of the holding company is, as well as the trading company. And now with trusts, it's the same. So a trust cannot be an anonymous way of holding assets going forward. It has to be declared within the world. So the trust has its own tax number, and that tax number is then associated with the beneficial owners of that. So a parent can settle into a trust, so that and potentially benefit from that trust, but they will be a beneficial owner or a party to that trust estate. But the potential beneficiaries of that, the children and or other beneficiaries of that trust, they also need to declare who they are and identify themselves with their tax number, their ID number for their passport or state ID, as well as address verification. So address verification, um, uh, national ID, passport or ID, and as the owners of the trust is now part of the requirements and a new registration requirement for Cyprus International Trust. Now, it doesn't mean that a Cyprus International Trust is going to pay any income or inheritance tax. What it does mean is that it's going to be checked and there's going to be exchange of information. So you cannot any longer uh, assume that on your death there isn't an exchange of information. If you've got £1 million of assets in your business or family trust based in Cyprus, and you're the beneficial owner or your children are the beneficial owner, when there's a significant change or movement of assets for whatever reason, there'll be a notification uh, of that will flow through the system. Uh, so that's a key point to understand. So anybody who has a trust at the moment that may not have its own tax number, it may not have its own regulation number, and it may not have been making a statement of beneficial ownership. That is all going to change going forward, and that changes from January 25 for Cyprus trusts. This is a legislation actually announced just before Christmas in Cyprus. Um, they're requiring the beneficial owner register to be updated by the end of January. They've already extended the beneficial owner for 2024 for companies from 31st of December to the 31st of March. So we do expect the trust uh, uh, ultimate beneficial owner registered deadline to be moved back from January to March, but that remains to be seen post Christmas. So a lot of work to be done for anybody who's holding a trust at the moment, and have have that in mind then, and consider that additional expense. Now, for existing clients who might say, "Well, I don't want that additional expense," have this in mind: those assets within that trust are not liable to any inheritance tax or any um, capital gains tax in any country elsewhere. There might be an underlying liability on the assets, in which case you need to review it with us to make sure that you know and understand what the underlying tax liability of the assets is. But apart from that, Cyprus is not going to, while they will acquire the information and accrue it, and they will now exchange that information with your home country or other relevant countries, there's still no liability to that as long as the assets are held within the trust. This is the point. Um, a company ultimately has a corporation tax liability if you don't distribute the assets. 25% in the UK, 12.5% in Cyprus. An individual, as a sole trader, has an income tax to pay on his net earnings, up to 45% in the UK or 35% in Cyprus. Um, Pensioners have a flat rate of tax to pay 5% in Cyprus or up to 45% in the UK. So those are situations that we know about and they remain. But the assets within the Cyprus trust are not subject to any tax. Um, and therefore that those income and capital assets held in a trust, shares owned in the trust of your UK company that are distributed into the trust are not taxed, because if the trust is getting the dividends, if the trust is getting the interest, if the trust is getting the income, there is no tax on that international trust. and therefore the Cyprus International Trust remains a valid way for family and business, not just to avoid current earnings taxes on dividends, interest, and earnings, but also protect you against capital gains and inheritance tax on debt. You can pass and gift property, investment, and business assets to your children across board and down generations without any inheritance tax liability at all, including any additional tax reporting on debt. So it's big inheritance tax savings, over 40% for UK expats using a Cyprus trust. You don't need to be a Cyprus tax resident. You don't need to be a Cyprus resident to have a Cyprus family or business trust. What you need to do is talk to us at preemptive.com and discover how we can reduce your tax level um, for working day to day, month to month, year to year in 25, as well as any potential liabilities for inheritance and capital gains tax in the years ahead. So, just to wrap up our summary there, thanks a lot for listening. We've covered 5 big things, changes are coming in for expats living and working abroad in 2025. The UK are introducing electronic travel authorities from the 8th of January. Unlike the EU, which have deferred it again, although Romania and Bulgaria are now full members of the Schengen zone, Cyprus remains outside that. So the UK electronic travel authority is required for any non-EU traveller into the UK, except Irish because of the common travel area agreement between the UK and Ireland, and except Cyprus because Cyprus is not in the Schengen zone and not likely to join the Schengen zone until 2026. And it's subject to Cyprus resolving the issue to either create a hard border between the north and the south, or to get a resolution. So we've got one unified island with one government and not a separate Turkish influence arrangement in the north. The non-dom rules are changing in the UK. This will have a significant effect for anybody that's already there. So once you've been in the UK for 4 or more years, in the last 10, you're deemed domicile and therefore liable to income, dividends, savings, and inheritance and capital gains tax on your worldwide assets, up to 45% taxes that are liable. So consider how you want to manage that and how you want to protect yourself going forward. You'll be deemed domicile for each year that you're tax resident in the UK, up to and including April 25 and the previous years that you may have been in the UK in the previous 10. So it's time to review and revise your liability and how to protect your income and capital from UK taxes going forward. We've said that UK corporation taxes continue to rise up to 25%, and they can be changed by reducing them down to 12.5%. For example, with the Cyprus Corporation, so you can more than half your corporation tax liability if you're working remotely, either as a sole trader or with a holding company. So if you've got a Cyprus company, you don't have to be in Cyprus to work with that, but you still pay the 12.5% corporation tax. If you're working from a UK company, you can keep those contracts and that trading business in the UK and use a Cyprus holding company to develop your business and pay a maximum 12.5% corporation tax. For more information and guidance, contact us at privatepartnership.com. We said that Cyprus citizenship rules change quite dramatically. So in the UK, you need to be in the UK at least 5 years and have a permanent residency and indefinite leave to remain before you can get your citizenship. 5 years is a minimum for a country around the world. Cyprus now has introduced a rule where for 3 or 4 years residency in the last 10, by spreading over the 10, you can get a fast track application for citizenship in Cyprus, um, uh, as long as you've been in Cyprus for the last 12 months. So if you're not in Cyprus at the moment, and you arrive here by the 10th of January, then by the 10th of January 26, you can be applying for citizenship here, as long as you've had at least 2 other years in Cyprus in the last 10 years, to change your status. For more information, guidance on that, contact us at preemptive.com. And the fifth area that we looked at today was trusts, where the trusts are getting pillared by the OECD exchange of information rules, so that now need a tax, an AML regulation number, and an ultimate beneficial owner register for all the trustee beneficiaries and parties to that. Irrespective of that exchange of information, that's going to impact everybody, and could lead to more taxes on somebody using a UK trust or any other British law, English law trust. However, a Cyprus trust for family and business pays no tax in Cyprus, and that's not going to change anytime soon. So you can generate more income and capital and avoid completely and utterly inheritance tax, up to 40% when you die. For more information and guidance, contact us at propartnership.com. Thanks a lot for listening to us. Thanks a lot for joining us at the start of 25, and we look forward to being with you during the year, and looking forward to a better year. I'd like to finish with you, because I've still got my Halloween logo up there. And there are some horrific moments in 2025, not least the budget that was delivered, and for fear of, it shouldn't be necessarily political, but the big lesson that I learned in 2024 was that socialism delivers power for elites, tyranny for the poor, and hatred and division for all. We need to pull together as a world. We need to come together and work for each other, and not be subject to any tyranny of any form. Thanks a lot for listening, and we'll see you again next time.